Hey, welcome back, everybody, to today's Market Explained. Today's Friday, March 6th, and we're going to give a recap on the markets today. No interview, just our regular market commentary episode. I'm Brian Castle, your host. I'm here with Mr. Christopher Reardon. Chris Reardon, welcome to the podcast.
Thank you, Brian. Afternoon, everyone. Glad to be here. Glad to talk about a little bit about the markets and all the crazy stuff that's going on right now.
There is a lot. And Chris is our director of development at FourStar, everything portfolio and development and asset management. He kind of leads that whole division. And he's a super smart guy, and he's got a very young family too. Young boy. How many kids do you have below five, Chris, now? Three, right?
Feels like 10, but it's
Feels
really
like 10.
very
It's exponential. Yeah, exactly. Well, great. Well, you're great to be with us today, Chris. Thank you. And I'm Brian Castle. I'm your host. I'm the CEO and founder of FourStar Wealth Advisors. I'm an advisor to insiders and CEOs, as well as the leader of the FourStar firm. And I am the husband to the amazing Tripti and father to two wonderful young men, Evan and Quinn. So there we are. That's our backdrop for today. Chris, let's talk a little bit about. Oh, yes, by the way, if you would please give us a 5 out of 5 ranking on Apple iTunes. The more rankings we get, the better it is. We're still ranked in the top 1% of podcasts, but we'd like to obviously keep our ranking up there and keep moving higher. So let's talk about the market today, Chris. It's been kind of a crazy week.
been a crazy week. And I mean, I would say it's been crazy from an asset allocation perspective since our last podcast, which was
Yeah.
really kind of middle of February. So if you guys remember, middle of February, we kind of had international overtaking domestic for that number one position. Domestic was slowly pulling back, but not a ton. But the biggest loser was commodities. We've seen a bit of a flip kind of coming into this reading. International equities is still number one. It lost 4 points though since the last podcast reading. Is at 292 now. Domestic equities lost 16 points since the last reading. It's at 272, still holding that number two position. But commodities, oh boy, did that thing flip. It's still in third. It's gained 68 points since the last podcast. It's at 256 now. So it came kind of roaring out of nowhere and is now, they're kind of in striking reach of domestic equities in that number two position potentially. So that's the big mover. The bottom three asset classes, surprisingly, obviously, usually when we have some volatile markets, you would expect cash to maybe rise. But cash was a big loser actually in the fourth position. I lost 15 points since the last podcast and is at 110 tally points. Currencies lost 16 points in fifth. It's at 86 tally points. And fixed income is still in last, and it also lost 16 tally points, dropping it to 70. So um, commodities was the big mover. It pulled a lot of tally points from a lot of the other asset classes, kind of pulling everything upwards. And a lot of that's due to, as Brian was kind of mentioning now with war with Iran and everything going on. The big driver is oil prices. It's hard to miss the news and everything on it, and that's kind of the big mover with that commodities.
So, Chris, why did this happen? What is the impetus for this 68-point move in commodities?
I mean, it's almost and I don't say entirely, but the driver is the oil markets right now.
Hmm.
The energy markets have been the strongest really we've seen since we saw kind of the volatility swings down and back up in the COVID-19 2020 days. We're seeing kind of numbers from a volatility standpoint and spike wise comparable to that. So really, really, really strong moves. With oil, it tends to be towards the upside. We've seen the US markets have been really interesting how they've acted. It's kind of a tepid response Monday when the markets opened, which a little unexpected. Before kind of get clobbered on Tuesday, recovering on Wednesday, clobbered on Thursday, and today as well, it seems to be down a little bit. So market's been, I think, having trouble digesting this info. I think certainly the kind of Iran they say invasion, but mostly kind of a bombing campaign, things like that. The war really going on with Iran. I think people knew it was potentially out there, but I do think people are kind of surprised at the scale. Even if they, you were kind of thinking it until you really see it, the scale that it's kind of happening at. So I do think that there's a lot of things that the market's really trying to kind of digest right now. And I think not only that, but the how effective the U.S. has been at kind of clobbering Iran right now. Um, what does that mean? Does that mean if the war is over next week, what's that ripple through to the market? So there's just so much right now. I think the market's really trying to digest it, and it doesn't know what to do. I think you got some strong up days, you got some strong down days, you got the market just kind of sitting flat. The market's really trying to kind of decide and then figure out which direction it really wants to go, which is interesting.
Yeah. So we've had a lot of materials and commodities in the sector of precious metals doing well. Brian Castle, I'm the CEO and founder of FourStar Wealth Advisors. Now we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. But now it's all energy, right? Energy, oil, everything oil is going up. And so commodities are right now in the short run where all the action is.
Yep. Yeah, I mean, and as we spoke about the last podcast, I mean, energy has been having a good year prior to all this. So this is just kind of icing on the cake, if you will, for that energy market as far as returns are
Mhm.
concerned.
Yes.
So
And then the other asset classes are just languishing down there far, far, far below the top three. But now we have this kind of convergence of the top three with international US in the lead, US at 272 and commodities 256. We're clearly in a bull market, but certainly hasn't felt that way as far as the stock market this week, though. The market seems to be, and we had a week of panic over AI about a month ago, and now we're having another week of panic, this time over the Iraq war. We're only 7 days into it as of now, because they started the war Saturday morning or Friday night of the previous week. Yeah, it's just a very, very unusual time, Chris. Very unusual time.
yeah, no, certainly. Um, so continuing that on, looking at the sectors, kind of what they're doing year to date. Energy, as you would expect, is still leading. It's now up 26.74% year to date.
Wow.
So kind of continuing to build on that. Materials is in second, and that's up 11.39%, followed by industrials up 11.14. Consumer staples are up 9.91 in fourth. Utilities round out the top kind of half or top half. They're up 9.42% in fifth. And then one more I'll highlight in sixth is real estate, and that's up 7%. So those top six sectors out of the 11, I think there's a big gap there. So when you jump from that sixth, which is real estate at 7%, the next sector is communication, surprisingly, at a nice little rally, but that is actually down 0.45%. So there's about a
Mhm.
7.5% gap there between that six and seven
Mhm.
over there. So there's a big gap out of that top six. And it's interesting because in those top six asset classes, you're looking at primarily defensive, consumer staples, utilities, even real estate to a degree. And then you're looking at primarily commodity driven materials, energy, industrials, you could say actually is somewhat defensive, somewhat commodities as well. That's where you have a lot of aerospace and defense kind of rolled up into there too. So
Mhm.
interesting as far as the sectors we're seeing. But
Yes.
rolling on through, Seventh is communications. That rallied up 3 places from since the last one. Healthcare is next. That got overtaken by communications. That's down 1.10%. Information and technology is down 2.66% in ninth. Consumer discretionary dropped 2 places. That's down 2.71% in 10th place. And then in last or 11th place is financials. It's still unchanged there, and it's down 6.16%. So financials have certainly been getting beat up pretty bad.
Yes. Yeah, it's interesting. We have quite a wide divergence between the worst sector and the best sector, -6 to +26. And the other really interesting thing about this market, Chris, is besides the broadness of the sectors, folks are aware of these concepts where the S&P 500 is a market cap weighted index. So the stocks that are in the index that have the largest capitalization have a higher percentage of the index. So we had those Mag 7 stocks, the Magnificent Seven, and they were dominating everything. And now those stocks are getting hit, where the NASDAQ is underwater for the year, and it's the worst index of all right now, year to date. And so the other way to calculate an index is if you take an equal weight of each name, and there's an index that we track called the equal weighted S&P. So right now the S&P 500 is underwater, but the equal weighted index is up, I believe, about 7% right now. And we have some portfolios that are up 10 and 15. We have one that's up 20%, even though the market is basically underwater, right? By the by the measurement of the normal S&P. So what you see S&P on TV, that's the market cap weighted index. They're not talking about the I'm sorry, that's it is a market cap weighted index, not the equal weighted index. But that's how most people buy stocks, in an equal weighted fashion. We don't put 40% of our money into 7 stocks and then 60% of our money into 493 stocks. That's not how people do it, but that's how the index is calculated, and people don't know that, and the S&P can be rather speculative. So we're going into a period of time now where it's easier to beat the benchmark by buying, individual normal positions than it is at times when those tech stocks are running. So it's really a very different dynamic in the market right now.
Yeah, I mean, it's definitely flipped a little bit. Kind of keeping on that same line of thought, value stocks have outperformed significantly. And some of that plays into utility, these defensive stocks for sure. But value stocks are actually up 8.54% year to date, whereas growth stocks, primarily a lot of those Mag 7s and other names, are down 5.48% year to date. So big gap there between these growth stocks and these value. Mostly you think blue chip dividend paying stocks. You're seeing a big divergence there. And then taking it kind of continuing forward from our last podcast, if you listen, breaking down the different market caps of the different companies and how those, because that trend has actually continued. It's closed a little bit, but mega cap corps, the big, the $1 trillion companies,
Yep.
those are still down 0.83% year to date. Large caps are up, but they're pretty flat. They're up 0.18%. Mid caps are up 5.52%, and small caps are up 7.48%. So we're continuing to see kind of a skew towards these smaller mid cap kind of style companies are outperforming so far this year. We'll see if that changes. I mean, I think obviously this last week, the dynamic of the market has shifted significantly. So that could change. But so far, the smaller mid cap companies have fared certainly better. And then looking real quick just at the international markets and how those have been impacted from the Iranian conflict going on right now. Developed markets have been up 3.25%. On emerging markets are up 5.43%. So both have fared somewhat well, albeit I will say they've had a pretty big pullback, in emerging markets in particular. At one point was up about 15.78% at its high. So it's pulled back about 10%. So even though they're still above water, they're still holding up. They have been taking on significantly as far as pullbacks within the last week to 2 weeks. So we've certainly
Yes.
seen them get affected.
Update on the equal weight, it's actually down a little bit from what I said to 4.75. So there's still a 5 point difference between the S&P equal weight and the regular S&P that you hear about on TV, right? Or in your quote system. So it's quite a different time.
Yeah, I mean, yeah, it's definitely, and I think obviously these numbers, these returns, are facing backwards. So it'll be interesting to see. A lot's changed in the last month, or even the last 3 weeks, I would say 2 weeks. I think it'll be very interesting as far as what it'll look like in another 2 weeks when we do our next podcast. Certainly there's a lot of things that are probably going to change. So it'll be interesting to see, depending on what plays out, what's going on with the war in Iran and all that.
Yeah. So as of now, the S&P 500 is down 1.24. The Dow Jones is down 1.3. NASDAQ composite is the worst because of all those big techs that were so big. Now they're so bad. Down 3%, 3.06. Although the small caps, as you mentioned, Chris, are up 2.12 year to date on that index. So we're seeing an outperformance in small caps. We've seen that for a while. But now the question is, once we stop going down and we grip and the correction is over, we think it'll only be a correction, by the way. What's going to lead coming out? Could it be small caps without international entanglements and things like that? That's kind of been the pattern in the past, that usually small caps will lead out of a market pullback in the beginning of a bull market, and kind of feel like we're in the beginning of a new bull market.
Yep. Yeah. I mean, I think, and I do think and we'll talk a little bit about it when you look at the economics, but there is definitely a lot of back and forth going on right now. Um, yeah, some numbers, jobs numbers, things like that have been kind of underperforming, but some manufacturing has actually come in higher than anticipated
Yeah.
and higher than expected. So, we're by no means, I think, right now kind of headed towards, or, we don't foresee a recession, but everything does change month to month. And so, certainly as things come in, if we do start to see that slow, it starts to put that potentially on the horizon.
Yeah, so on the economic front, as you say, Chris, I mean, we still think we're in a decent economy. Clearly this Iran war situation is going to have some repercussions in the short run, but generally the economy is stronger, money's coming back to America, businesses are coming back to America. So why don't we dig into those numbers,
Yep.
manufacturing and jobs and consumer?
Yep. Yeah. So from the manufacturing front, we got two of the major reporters, the ISM and the S&P Global. Their PMI, Purchasing Managers Index, which is mostly kind of the activity, if you will, that you're looking for. So the ISM manufacturing PMI for February came in at 52.4. That beat expectations, which were for 51.8. And so for any of these numbers, anything above 50, is expansion. So that's positive.
Hmm.
Whereas the ISM non-manufacturing PMI, so services, things like that, came in at 56.1, which is well above expectations, which were for 53.5. So two positive numbers overall from the ISM. The S&P Global, they do their own PMI. So theirs for February, their manufacturing, it came in at 51.9. That was down slightly from January's. January was 52.3, but still in that growth trajectory. And the S&P Global Services PMI, that came in at 51.7, down slightly from 52.3 in January. So kind of two contradicting numbers. There's no perfect science to this. They both have their own processes, their own surveys, things like that they look at. So you're never going to get perfect reads. We've seen that a lot. We've seen a lot of numbers that have gotten updated, revised down, revised up significantly. So we can just kind of, I would say with that, every number at least read above 50. So we are in expansion. We're not seeing major contraction or anything yet from a kind of manufacturing activity standpoint, which is overall positive from the U.S. economy. Flipping over to the jobs, that we got some big data today that the market's digesting. So non-farm payrolls for February came in at a negative 92,000, which was a huge surprise as expectations were for a gain of 59,000. So pretty significant reversal there. With that, the unemployment rate jumped up to 4.4% from 4.3, so a slight tick up there. And the average earnings year over year in February were slightly higher. They ticked up 0.1% to 3.8 from 3.7 in January. So, overall, kind of tepid numbers there. But once again, there's two different surveys. So ADP, which is a major billing, a major company kind of report, they do their own, and their monthly report on business payrolls showed a growth of 63,000 jobs in February above expectations. The expectations there were for 48,000. So, and it's interesting, non-farm does include government. It does include certain areas that aren't necessarily covered in ADP. And, a lot of businesses, private businesses do use their payroll services. So, it does have some decent insight, but it's not maybe going to be as comprehensive. But once again, we're getting kind of an interesting mixture. I do think it'll be interesting as we get, March, April, is this a continuation of the trend? Or is this an anomaly? On the jobs, I think the December and January were also revised down slightly as well. So we'll see. Are we starting to see that crack, that weakening in the jobs market that Brian and I have spoken about on here probably for the last year? I think it's been kind of foreshadowed that we were going to have a pullback in the jobs market, and it just never really happened. So is it finally here? Are we seeing that? We'll just have to kind of see and let that data play out. For
Yeah.
the consumer, January retail sales were negative 0.2%. So it was down, but it did slightly beat the estimates. Estimates were for negative 0.3%. So kind of a down, but we still beat there. And consumer confidence actually rose slightly in February. It was up to 91.2, up from 89 in January. So a slight rise. And then the last little bit on the US markets, I'll touch on the average 30-year fixed mortgage rate fell to 5.98%, which is important to note because that is the first time it has dipped below 6% since September of 2022, when the rate increase, so the rate rise cycle kind of started happening. So
Yeah.
there's a lot of dynamics, I think, at play there. But it'll be interesting. I think the market's digesting this a little bit now, but all it really takes is, especially with the recent data, if we start to get a trajectory that the Fed is going to cut rates, that could be a catalyst for a rally in the market, like you said, Brian, off this correction. There's a lot of things that are out there. I don't foresee this as a complete collapse by any means.
No, not at all. And the housing market's been a little stuck though, as you said. It's significant that the mortgage rate, Chris, went below 6% for the first time since 2022. So that is significant. And there is talk in Congress about doing some sort of a package to get the real estate markets unstuck. There's a lot of different things they could do. Tax incentives to help first-time home buyers. Average age of the first-time home buyer is now the highest average age ever in history, 41 years old. It used to be in the high 20s, right? When 20-year-olds would buy their first house after they got married. So that's all changed. Then also, there's lots of seniors in homes with lots of bedrooms that are unused, and they could create incentives to kind of free up some of that space as well. But the reason they're not selling is because they have huge capital gains, and they could pass that on to their heirs, so they can maybe change the tax code a little bit to make that work better for folks. So there's a number of things I know the leaders of Congress are talking about doing to get the real estate markets unstuck. Naturally, this mortgage rate falling below 6 is going to help, but it's probably not going to be enough. There's probably more things need to be done.
Yeah, I mean, 100%. It's not, the markets, it is definitely slowed. I mean, it's still obviously moving, but this isn't, I don't think, going to be this game changer necessarily for it, but it does show the trend is moving in the right direction. And if we see the economy deteriorate a little bit more, especially the job market, if we start to see that, the market might start to factor in some more rate cuts, which will, once again, it's never a 1-for-1. I think that's a misnomer. I think a lot of people think, oh, the Fed's cutting 0.25%. So that means if typical 30-year mortgage is 6%, that it's going to drop by 0.25 as well. That's never the case. But it will put pressure on those rates to come down.
Mhm.
They are going to come down slowly, but as I said, as long as they're moving in the right direction, hopefully that starts to kind of get the real estate moving a little bit more.
Right. So let's talk about international, Chris.
Yep.
That's
A
all
couple.
changed. That's all changed this week too, hasn't it?
Yeah.
Thanks, Tom.
Well, outside of everything going on in the Middle East and everything, one thing I just wanted to highlight from the international front is China. A couple interesting things we got out of China since the last podcast. So they set their 2026 GDP growth target to 4.5 to 5%, which seems like a lot, but for China, that is extremely slow. And it's the slowest, in fact, it's the slowest pace since the 1990s that they've kind of forecasted out. So it's interesting. Is this signaling, the kind of day and age, if you will, of China clipping at 7-8% growth GDP per year? Is that starting to come to an end? Is China kind of finally getting to that level where they're just going to start kind of creeping forward, similar to most developed economies, really? So that's interesting that they were forecasting. And then looking at their kind of manufacturing and factory activity. So China's manufacturing PMI fell to 49 in February. And that's the second straight month it's below 50, which to recall from earlier, anything below 50 is contraction. So their
Right.
manufacturing is still in contraction now for the second straight month. And then China's non-manufacturing PMI came in at 59.5 in February. So we're still seeing they're having trouble, if you will, getting their economy started, getting that growth engine going. There has been suspicion and whispers that, with some of these readings, we're going to see potential stimulus out of Beijing. That is certainly out there. Beijing definitely likes to do that and has a pattern of doing that to help jumpstart their economy. So that's something we'll keep on the lookout for, potentially coming down the pipeline there. When that does release, a lot of it's going to depend on, what shape does that look like and how much are they going to be kind of pumping into the economy then. So certainly interesting things to look at. And then flipping over real quick, I'll just cover 2 points on commodities. As we talked about, with everything going on in the Middle East, oil has been the biggest mover. In fact, Brent crude this week is set for its strongest weekly gain since that COVID-19 pandemic in 2020. It's up about, as of right now, 24% just this week, Brent crude. So a lot of volatility right now in the oil markets. And then something that could be coming down, it's certainly not impacting right now, but the Gulf War is also disrupting fertilizer supplies. Obviously, you have the shipping routes being disrupted, things like that. So fertilizer routes, supplies, all that stuff are getting disrupted, causing prices to jump. And right now we're kind of entering the spring season, which is typically planting season. And so it's not an ideal time. Prices at the New Orleans import hub, sorry, rose from $5.16 per metric ton to $683 per metric ton in the last week. So that does have a substantial impact, obviously, on potentially food prices. And these are all things that are, potentially 4 or 5, 6 months from now, not immediate, but certainly things to keep in mind that even though we're seeing immediate effects of the war and oil prices, things like that, there are other layers that are kind of being ripples that are being felt that are going to keep this disruption happening potentially for the next 6 months, if not more.
Absolutely.
So and that's all. That's what I got
So
from those
that's
from.
what we got. Okay. Well, the economy we think is still getting better. This week is a little bit of a diversion, but we think, hopefully things will settle down. They say this war is going to go on for a couple more weeks, and some of the toughest things are yet to come, but you never know if that's true or that's just posturing. Um, but nonetheless, there's a realignment going on in the world, and that's being led by the United States with President Trump. So it will affect the economy, but generally the trends, including the redo of the tariffs and everything, it will probably make the economy better here in America. So we still think that's the base case, and so we'll keep watching for that this week. being a very tough correction nonetheless in the market. We think the markets will probably do better later this year. So, well, great. Well, what do we see out there, Chris?
Yeah, a couple interesting things. One of the first ones, so one of the major losers of kind of this Iran Middle East conflict has been U.S. airlines. So, U.S. airlines stopped hedging their fuel costs. So back in the day, they used to hedge their fuel costs to help, lock in those prices to know what they could charge passengers. For some reason, U.S. airlines moved away from that. And that could have really hurtful consequences to the bottom line. Jet fuel prices have risen 15% just in the past week. And I think that's the third biggest budget item as far as
Mhm.
cost for airlines typically. So you can see how the impact that's going to have on their bottom lines potentially.
Mhm.
Interestingly, European airlines still hedge their fuel costs. So you're looking at airlines to take, probably not impacting right now, but potentially, next couple weeks, your ticket prices might be going up pretty quickly. So
Mhm.
you're gonna book
Yes.
now. The Pentagon and Anthropic have been on a months-long dispute now over company safeguards. The Pentagon has recently slapped a supply chain risk label on Anthropic this week, and that bars government contractors from using Anthropic technology in their work for the U.S. military. So, been a lot of back and forth. This has been in the news a lot. We'll see how it ends up. But certainly, it's there are certain dynamics. I think this is
Mhm.
AI, and how should that AI be leveraged and things like that. So,
Yes.
definitely been a hot topic there. And then Paramount Skydance. This has been an interesting saga going back to, I want to say, September or October. But Warner Brothers, Paramount Skydance won the bidding war for Warner Brothers, and this comes after, I want to say, November. Um, the news was out that Paramount Skydance lost the bid
Mhm.
to Netflix. This came them full circle as Warner Brothers Paramount continued to up the offer. They kind of continued to migrate and almost got into pretty much a bidding war, and got to the point where what they were bidding, Netflix wasn't willing to come to the table with. They said it wasn't economically feasible for them at that point. So, really interesting dynamic there. And that's a really big deal. I mean, Warner Brothers has major franchises, the HBO app, things like that are probably now going to get rolled under the Paramount brand now. So, big shakeup there in the media industry. And the last thing, so China has finally approved Pfizer's GLP-1 weight loss drug for China. So that'll be interesting and probably going to be a big boost to the bottom line for Pfizer's sheet there, as well as that gets rolled
Mhm.
out for that country.
And Eli Lilly as well. Yes.
Yep. Manila
They're all,
Lilly, well, they've
yeah.
got.
And it's helped the countless millions of Americans lose weight, and it's quite good. There are some side effects to it, but our we're having lots of health issues in America because the food systems have gotten a little bit crazy. So now they're cleaning up a lot of the food. There's too much sugar and too many processed foods. So we're trying to go back to whole food. So that's all changing. That's not an economic thing, except you live longer. That's a good economic thing, right? So, and the GLP drugs have had a lot to do with that as well. So, that's great, Chris. Well, thank you. I think that's all we had. So with the markets, Chris, moving as crazy as they are, I just want to remind everybody that FourStar has a program called the FourStar Protection Plan that will raise cash in portfolios and get partially, or in some cases, completely out of the risky financial markets for a period of time when things are getting really rough. We checked as of yesterday. We have not gotten our first set of signals to go to position one. We have 4 positions that will take us from fully invested all the way back to maximum cash levels. We did that last year, about a week before President Trump announced the tariffs, and the markets were really rough back then. The markets came back strong, and we got back in. We've only gone to maximum cash 8 times in 31 years. But some of the time we'll go to position 1 or 2 and not go all the way to 3 or 4. But it does dramatically limit how much you lose in the market. And our average has been about only a third of what the markets are down that we bear that risk. where most folks just ride it up and all the way down and all the way up. And, it's a real volatile, especially if you're a retiree, it's hard to take the portfolio volatility. So we designed that program, the protection program, but just for the record, right now, we're still not in protection mode. We've had a rough week, but wasn't enough to turn things sour. But nonetheless, if we need to, we will. And so right now, our four-star models are still fully invested. We're hoping that the end of this volatility period is very soon, hopefully today. But time will tell. So anyway, I think that's it. I think that's what we have for today, Chris.
Yeah, I think that about covers it kind of for the beginning of March.
Well, thanks everybody. Thanks for being with us. Sloppy markets right now. We still think the economy is decent. We think it's still hopeful it's going to be a good year. We get through these all these wars and things going on in the world to kind of clean things up. But we'll see how it all goes. Thanks for being with us today, everybody, on today's Market Explained. We'll be back with another episode. We're going to be doing some other interviews this spring as well with a lot of different players in this market. We did an interview with Bill Boscow on the manufactured housing and the real estate market. We're going to do another real estate interview very soon as well. So we look forward to that and look forward to those future episodes. Thanks everybody for being with us. FourStar, Chris, we're over and out.
Yep. Take care, everyone.
Goodbye, everybody.